Welcome back, energy sector enthusiasts. In today's video, we're diving deep into four major players in the global energy sector: ConocoPhillips, Chevron Corporation, Equinor, and Exxon Mobil Corporation. These companies are key pillars in the oil and gas industry, and their financial metrics provide a lot of insight into their future potential and current standing. So, without further ado, let's jump into the numbers and get started. We'll start with one of the most popular metrics used in investing, the price-to-earnings ratio, or PE. It gives us a quick snapshot of how much investors are willing to pay for each dollar of earnings. Leading the pack here is Exxon Mobil Corporation, with a trailing 12-month PE ratio of 12.91. Right behind it is ConocoPhillips at 12.82, Chevron Corporation at 12.16, and Equinor coming in last with a PE ratio of 7.60. From this, we can see that investors view Exxon and ConocoPhillips more favorably, valuing them higher relative to their earnings, while Equinor's lower ratio might suggest it's undervalued or that investors are more cautious about its future earnings prospects. Now, let's look at the 5-year average PE ratio. Here, Chevron leads with a slightly higher average of 12.62, while Exxon Mobil and ConocoPhillips are also in the same ballpark, with averages of 13.38 and 11.99, respectively. Equinor's average sits at 12.88, indicating that its current valuation is below its historical norm. This might suggest that Equinor's stock has room to grow if it can meet or exceed future expectations. The forward PE ratio, which accounts for expected future earnings, paints an even more interesting picture. Here, ConocoPhillips comes in with a forward PE of 12.33, Exxon Mobil at 13.10, Chevron at 11.35, and Equinor leading with the lowest forward PE of 7.50. This could indicate that investors expect a significant earnings growth for Equinor or that the stock is undervalued. Moving on to the price-to-earnings-to-growth ratio or PEG, which is a more nuanced metric that accounts for growth expectations, we can see a different story unfold. ConocoPhillips shines here with a PEG ratio of 2.47, closely followed by Exxon Mobil at 2.48. Chevron lags with a 3.38, and Equinor has the highest PEG at 3.46, suggesting that its growth may not be adequately priced relative to its earnings. For long-term investors, lower PEG ratios often indicate better opportunities. Next, let's look at insider ownership, a metric that can be telling when it comes to understanding how much skin executives have in the game. Exxon Mobil takes the lead here with 0.16% insider ownership, followed by ConocoPhillips at 0.08%, Chevron with just 0.03%, and Equinor with no insider ownership to speak of. While these percentages might seem small, any insider ownership is generally considered a positive signal, as it shows executives are personally invested in the long-term success of the company. Now let's continue with some profitability metrics. Return on equity is a measure of financial efficiency, showing how effectively a company uses shareholders' equity to generate profit. ConocoPhillips leads with a return on equity of 21.9%, followed by Equinor at 20.62%, Exxon Mobil at 14.62%, and Chevron with the lowest return on equity at 11.79%. The high return on equity of ConocoPhillips and Equinor are encouraging signs for investors looking for strong profitability relative to shareholder investment. When we switch to return on assets, a similar picture emerges. ConocoPhillips again leads with 11.48%, followed by Exxon Mobil at 8.29%, Chevron at 7.31%, and Equinor at 7.02%. These return on assets figures indicate that ConocoPhillips is the most efficient at converting its assets into profits, which is always a good sign for investors looking at operational efficiency. In terms of return on invested capital, Equinor surprises us with an impressive 38.23%, far outpacing its peers. ConocoPhillips follows with 21.23%, while Exxon Mobil and Chevron come in at 18.15% and 13.12%, respectively. This metric is critical because it shows how effectively a company is using its capital to generate returns. Equinor's high return on invested capital suggests that it is exceptionally good at allocating its capital, making it a strong contender for investors focused on long-term growth. Another important metric to consider is the evolution of shares outstanding, which can have a major impact on shareholder value. In this case, all four companies have maintained a very similar amount of shares outstanding during the last decade, with some years doing buybacks and other years increasing the number of shares. When it comes to earnings per share or EPS, Chevron stands out with the highest EPS at 11.98, followed by Exxon Mobil at 8.93, ConocoPhillips at 8.57, and Equinor at 3.27. But it's not just about current earnings. We also need to look at the projected growth over the next 5 years. ConocoPhillips and Exxon Mobil both have a projected EPS growth rate of 5.2% compound annual growth rate, while Chevron's is lower at 3.6% and Equinor's at 2.2%. Historically, Equinor has had the most impressive EPS growth over the last decade, with an 8.12% compound annual growth rate, followed by ConocoPhillips with 5.49%, Chevron with 1.91%, and Exxon with 2.2%. This demonstrates that Equinor has been the most consistent earner among these companies, although ConocoPhillips also shows strong long-term earnings potential. Free cash flow is another critical metric, as it shows how much cash a company generates that can be used for dividends, buybacks, or reinvestment. Equinor again leads with a 31.35% compound annual growth rate in free cash flow over the last decade, but with very inconsistent evolution. Followed by ConocoPhillips with 23.5%, Chevron with 19.28%, and Exxon Mobil with 12.09%. Equinor's strong free cash flow per share growth makes it an attractive option for investors who value cash-generating capabilities. For dividend-focused investors, Chevron offers the highest yield at 4.48%, with quarterly payments of $1.63 and very consistent growth during the last decade with 4.3%. However, its free cash flow payout ratio is over 60%, being necessary to be more cautious. Continuing, Exxon Mobil comes in second with a yield of 3.3% and quarterly payments of 95 cents. Surprisingly, its growth rate during the last 10 years is lower than the Chevron ones, but its free cash flow payout ratio seems healthier, around 50%. ConocoPhillips offers a more 2.84% yield with quarterly payments of 78 cents. Unfortunately, due to its inconsistent dividend payments, the dividend growth of this company during the last decade barely is positive. Finally, Equinor boasts an impressive 12.07% yield, thanks to its combination of quarterly and special payments of around 35 cents. The free cash flow payout ratio in this case exceeded 100%, so it's clear that during the next year the probabilities of cutting their special dividends is too high. In terms of operating margins, Equinor shines with a margin of 30.67%, demonstrating its strong operational efficiency. ConocoPhillips follows with 26.23%, while Chevron and Exxon Mobil lag behind with operating margins of 12.06% and 12.28%, respectively. Equinor's strong margins suggest that it's doing a better job at converting revenue into operating income compared to its peers. Looking at profit margins, ConocoPhillips leads with an 18.92% margin, followed by Equinor at 9.14%, Exxon Mobil at 10%, and Chevron at 9.48%. ConocoPhillips' higher profit margins suggest that it is the most efficient at converting sales into actual profits, which bodes well for its overall profitability. In terms of the evolution of revenue and earnings, Exxon Mobil has seen the most positive evolution, which has been reflected in its market price, achieving a return similar to the S&P 500 ETF, VO, over the last 5 years. ConocoPhillips has also seen positive revenue and earnings growth, and their stock performance has slightly lagged behind the broader market. Finally, Chevron and Equinor, on the other hand, have shown less positive evolution of revenue and earnings, and this has been reflected in its market price, which has underperformed the VO and the energy sector ETF during the last 5 years. Debt levels are always a concern when analyzing companies. ConocoPhillips boasts a healthy debt/EBITDA ratio of 0.74, while Chevron has the lowest at 0.48. Exxon Mobil and Equinor have ratios of 0.56 and 0.71, respectively. A lower debt/EBITDA ratio indicates that these companies have manageable debt levels relative to their earnings, which is a positive sign for investors worried about financial leverage. However, when we look at debt/free cash flow, the numbers tell a different story. Equinor has the highest ratio at 4.25, indicating that its debt is high relative to its cash flow. ConocoPhillips and Chevron are in better positions with ratios of 2.04 and 1.10, respectively, while Exxon Mobil sits at 1.28. Lower ratios are generally better here, as they indicate that companies have sufficient cash flow to cover their debts. Now let's talk about stock performance over the last 52 weeks. Exxon Mobil has performed the best, with only a minus 0.97% drop, while ConocoPhillips saw a minus 9.33% decline, Chevron dropped by minus 12.60%, and Equinor suffered the most with a minus 24.44% decrease. Despite the challenging market conditions, Exxon Mobil has shown resilience, making it a more stable choice for investors. In terms of market capitalization, Exxon Mobil is the clear leader with a market cap of $512.12 billion. Chevron follows with $266.44 billion, ConocoPhillips with $127.59 billion, and Equinor with the smallest market cap at $68.52 billion. Now, let's talk about the crystal ball moment: analyst expectations and fair values. Analysts have set varying price targets for these companies over the next 12 months. ConocoPhillips has a price target of $136.93, representing an upside of 24.63% from its current price of $109.87. My fair value estimates tell a very different story. For me, ConocoPhillips is close to its fair value at $106.72, suggesting it is fair valued. Continuing with Chevron's price target is $173.73, which actually represents an upside of 19.25% from its current price of $145.68, indicating that analysts see the stock as potentially undervalued. And for me, Chevron, with a fair value of $139.52, appears currently slightly overvalued. Now, Equinor has a price target of $28.74, with an upside of 15.61% from the current $24.86. And for me, with a fair value of $32.39, can indicate an undervaluation of this company. Finally, ExxonMobil's price target is $130.78, representing a modest upside of 13.46% from its current $115.27, with a fair value for me of $109.86, which is not close to the current price and can indicate an overvaluation. These valuations indicate that while there is some potential for growth, investors should tread carefully and consider these stocks' current pricing relative to their intrinsic values. So, there you have it. Each of these energy giants has its own strengths and weaknesses. ConocoPhillips stands out for its strong earnings growth and profitability, while Equinor shines with its impressive cash flow and operational efficiency. Exxon Mobil offers stability and solid dividend returns, and Chevron provides a high yield and strong cash-generating potential. Depending on your financial goals and risk tolerance, each of these companies offers unique opportunities. Let me know in the comments which of these energy stocks you think has the best long-term potential. If you found this analysis helpful, don't forget to hit that like button, subscribe, and ring the bell for more in-depth financial insights. Until next time, happy investing!